What's up, guys? On this episode of the podcast, I sat down with Chris Rivera, who is the CFO of Zendrop and the CEO of the eCommerce Accountants. We talked everything tax related, and he gave us some awesome tips on everything that you need to know if you're just starting out with a dropshipping business or if you're a seasoned vet. Enjoy.
Good.
3, 2, 1, we're live. Chris Rivera, what's up, buddy?
Awesome. Excited to be back on again.
Excited to have you. So I guess real quick, just for the people who don't know who you are, brief recap, who you are, why are you here?
Yep. So I am Chris Rivera. I'm the CFO for Zendrop. I have been working with you guys now for about a year and a half, January 2019. So actually almost exactly a year and a half. So I've been around for the initial launch of Zendrop up through now. I've had a lot of growing pains, as you know, you can relate. Just excited to continue to be working with this company. So
Cool. Yeah. So you're the CFO of Zendrop. You're also the CEO of your own company, right?
yeah, so I own a firm called the eCommerce Accountants. So we specialize in accounting and tax for e-commerce businesses. I'd say about 70 to 80% of my clients now are actually dropshippers. So a ton of overlap between my clients and the people that, we as a team are looking for with Zendrop. So it's been really great for us to kind of have both sides of it, where I personally, I work very closely with dropshipping entrepreneurs, and I can kind of see their pain points, and being able to help, the rest of the team with Zendrop to really understand, like, hey, these are the tendencies that we see with dropshipping entrepreneurs, and this is what they need. And I feel like that's one thing that I've been able to bring to the table. So
What would you say is the main difference between accounting and bookkeeping for a regular business, maybe a brick and mortar, and e-commerce business, specifically like a dropshipper?
yeah, so number one will be a high volume of transactions. So as a lot of people that are going to watch this are aware, or I'm sure are aware, is you can scale much larger when you're marketing digitally. So instead of having like a corner store where you only have foot traffic where people walk in, you have an online store where you can really sell all over the world as long as you can ship to wherever your customer is located. So the high volume of transactions is extremely tricky. And what's unique about this space and why I've been able to carve out a niche outside of working with you guys in Zendrop is a lot of accountants, bookkeepers, tax professionals, etc., can get bogged down in that detail and don't really understand the real story behind the high volume transactions. And that's kind of how Jared and I got connected, and how I got started working with you guys in the first place. Is I took over from, your quintessential accountant that, was doing bookkeeping and tax services, and he was kind of getting lost in the weeds with, the thousands of transactions that Jared was dealing with on a daily basis. So that's the main difference between, e-commerce and accounting for like a brick and mortar business, let's say.
Why do the large number of transactions pose such a potential risk?
Yeah. So the best way I can put it is, if you think through, so a lot of entrepreneurs work with QuickBooks, let's say, right? So ordinarily what happens is, if you have like a service-based business, let's say you have a social media marketing agency, okay, it's a lot easier to account for that type of business because the transactions are fewer, where if you think about it, you link up a bank account or a credit card to a QuickBooks account, it's only a handful of transactions that come in, and literally in accounting software, you categorize those transactions. So if a Facebook charge hits your credit card, you categorize that as ad spend. If a deposit from Stripe hits your bank account, that's revenues with the merchant fees netted out, et cetera. But if you think about it, with e-commerce, if you're selling through multiple channels, now you have, 4 to 5 payment processors that are all depositing into your bank account same time every day, and buried in that number is refunds, chargebacks, merchant fees, et cetera. Not to mention, the army of VAs you're paying, Facebook, you have a whole slew of $900 charges hitting your credit card, every day. So depending on how large you scale up, the volume of transactions can be substantial. And that's really what makes this space unique from at least an accounting and tax standpoint.
And so the large volume of transactions pose a risk because it's kind of difficult to tell what's buried in that detail of where could I potentially save more money, where am I overspending, where are the holes in my business and how can I fix them? It's hard to identify those.
For sure. Yeah, and the other thing too is, and I run into this all the time, this space that we're in is a space filled with solopreneurs. So like you can have one person, and I see this all the time, one person behind a computer screen, and they can scale their business up to 7 figures in sales very easily, okay? Whereas traditionally in the business world, a business like that would have more headcount. So you have more resources, more people to divvy up the work. So that also kind of increases in the risk where you have one person that scales up a business that large. And, oftentimes I have people that aren't even 18 years old yet that have hit 7 figures in sales. Like that's kind of the business world we're moving into, at least in this e-commerce space, where you have these people that are really brilliant marketers, but maybe they don't have the accounting background or the business experience to know, how to set up a business entity or all those things. So all those things also increase your risk in not only an accounting standpoint, but other areas as well, just because it's so easy to scale a business in this space,
Yeah, I mean, typically you used to have to scale fairly slowly. You'd hire people as you scaled, but like you just mentioned, I mean, you could literally scale up in 30 days from 0 to 7 figures, and it really, I mean, you could just do it by yourself essentially. Obviously, you need to hire a support team and more people as you scale, but it's kind of disproportionate to the dollars that are coming in versus people that are helping you in your business.
Yeah, for sure. And that's something that I feel like, at least at this point in time, it's very unique to e-commerce.
Yeah, for sure. So I guess what would be one piece of actionable advice for someone that maybe in those shoes in the future, or may have, potential to run into that issue? What would you say?
Yeah. So a couple of things. The first thing is, and this is one thing that was originally, it was, at least in this space, I noticed with Jared understood this very, very early on, is don't discount the value of financial data. As an entrepreneur, what I tell people all the time is you need 2 things. You need something quick and easy to move fast, and something super, super accurate so you can make big time decisions like over the course of historical data. So let me break those into 2 separate topics. So the first one is you need financial data that you can move fast on. A Google sheet that you can spend 20 minutes on a day that says, was I profitable yesterday? Did I make money last week, etc. Maybe it doesn't include all of the expenses, every single VA you charge, some estimated charges, etc. But it's something that you can move fast so that as an entrepreneur, if you lost money over the last 3 days, it's like, I got to stop what I was doing over the last 3 days, figure out what went wrong and fix it. Okay. So that's one side of the coin. And there's ways you could do that through systems like Order Metrics, or a new tool that we're working on behind the scenes to develop. Or a lot of people like to use a Google Sheet. So something you can move fast on. Now, that is not good for, number one, doing your taxes with, because it's not a completely thorough list. But number two, it's not entirely accurate. So to your point, there might be instances where you're paying a $20 subscription for 8 months and you don't even realize that, like, you meant to cancel it 8 months ago, but they're still charging your card. So the other side to the coin is you implement a system like QuickBooks, let's say, right? So that is purely based on the transactions. You link up your business bank account, business credit card, and everything that hits that bank account, credit card, etc., hits that QuickBooks account. So you don't miss it. Nothing is missed. Nothing slips through the cracks. So that, in theory, should give you your super, super accurate profit number. So you need the kind of both at the same time. Something move fast, so you can tell, like, high level, did I make money or did I lose money yesterday? And then something that you can't move as fast on, but is super, super accurate, that says, okay, here's how much money I actually made last month. And that could be alarming to people, the difference between the two. Because sometimes moving fast, you assume a lot of things. But when you see the real deal detail, like, wow, I only had 10% margins, like, what do I need to fix to improve on my margins?
So
having both in tandem is super important.
I think that this is super valuable information. I would like to dive into both in detail. I think that'd be really helpful for people. So the first thing you mentioned was something like a Google Sheet or something similar to be able to move quickly. So if you could break that down a little bit further on, if you were going to take over, you were going to onboard someone, for an e-commerce accountant client, you were going to say, this is what we're going to set up. We're going to set up option one, move really quickly. And then option two is more detailed, as bookkeeping, right? What would option one consist of if it were a Google Sheet? So someone listening could formulate what they'd need to have a sort of bird's eye view of their business.
Yep. So obviously top line revenues is where you start. So super, super important to know what your top line revenues are. And every business is different. So top line revenues for you as a traditional dropshipper might just be pure sales related to orders. There are people out there that have subscriptions tied to their stores and other streams of revenue, but just high level, let's say you're a pure dropshipper, you have your sales from orders. And then if you have some sort of subscription or something like that, that would also be revenues. And so you want to include that as your top line revenue.
If you had subscriptions, recurring subscriptions that people were paying you, not subscriptions like a Shopify payment.
Yes. If you're charging subscription fees to customers, let's say, that would be included in your revenue.
So total revenues, the money you're bringing in.
Yep. Then what you'll want to do is you'll want to back out your merchant fees. We'll get to that in a second, actually. So you want to back out really your refunds and your chargebacks are major items that you have to consider. And don't forget that a lot of the people in the space are on, let's say, Shopify payments and PayPal. So you want to make sure you're not missing one or the other. You want to include both, refunds in both and chargebacks in both. So you have an accurate idea of, where you're at from a revenue standpoint after you net those things out. So I would say top line revenues inclusive of both your orders, and then if you have subscriptions applicable, that's your starting point. Then you back out chargebacks and refunds. Beyond that, the main items are, your cost of goods. So what are you paying your supplier, your sourcing agent, in our case, Zendrop, for per unit, or for that day's sales? What was the cost of those sales? Oftentimes, at least with our platform, you're paying by order. So you want to know how much you paid yesterday for Zendrop orders, that you fulfilled. So cost of goods sold is very important. Another thing, and this is going to be an obvious one, is how are you scaling your store? Because as I'm sure everyone out there knows, or you're about to learn, you throw a Shopify website out there, no one's going to go to and buy your stuff. Maybe your friends and family will go and buy your stuff, but unless they have something driving them to your page, your customers to your page, you're not going to get any sales. So if you're scaling through Facebook ads or Google ads, or something that's very hot right now is TikTok or Snapchat ads, whatever you're paying for that traffic, your paid advertising, that's an expense as well. So you want to factor that in. Yesterday, how much did I spend on ads to get my sales and the cost of goods? So now we talked about ads, we talked about cost of goods, transaction fees, your merchant fees. I see this all the time where entrepreneurs miss this in analyzing, like, oh, yesterday I did, $10,000 in sales, but really when it goes through that gateway and that payment processor, what really gets spit out into your account is not that 10,000 in sales. They net out certain things and you get a net number. Usually they'll net out your refunds, your chargebacks, and your merchant fees. So your merchant fees also need to be considered as well.
And the merchant fees, I think a lot of people sleep on, and I'm glad you brought it up because it's such a significant portion of potential profit, because you're getting charged the merchant fee on the total gross sale. So if you're selling something for $10 and you're accepting 3% fees on that transaction, plus the 30 cent, right? It's usually like 2.9 plus 30 cents or whatever the standard rate is. You're really getting charged about 60 cents on that $10 transaction, which is actually about 6% of the gross sale. And let's say you get the product for $5, right? And then your cost per acquisition is $3. That's 60 cents out of that $2 margin is very significant. I mean, that's 30% of your total profit margin. It might seem small, but especially with those lower volume transactions, because they're charging you that 30-cent fee as well, you're looking at 30 to 40% of your total profit margin being eaten by those fees.
For sure. So understanding thoroughly your processing fees is extremely important, especially so a lot of people, especially in the beginning, are on Shopify payments, PayPal, and Stripe. Okay. So those are the companies that are very rigid in terms of what they're charging you for processing fees. Once you get out of that and you start moving on to third-party processors, that is like the wild, wild west. So you got to watch out for those companies and make sure that you're auditing what they're charging you on a monthly basis or on a transaction basis or whatever. Because oftentimes those companies will, number one, they'll negotiate with you. If you're unhappy, you can negotiate to drive down your fees. But also you want to keep a pulse on what you're paying in terms of your merchant fees, because, like I said, it's a wild, wild west. So I've seen processing fees upwards of 15% for some high risk, processors. So definitely something to look out for. But in terms of, if you're still in that space of using Stripe, PayPal, Shopify payments, it's pretty much standard across the board what they charge. So definitely keeping a pulse on it is easier, but definitely don't sleep on it, because to your point, if your average order value is very low, that 30 cents portion of the merchant fees can be substantial, in terms of eating into your margins. So
yeah. High level, this bird's eye view of where is my business at, you're taking all of the money you get right from customers as your revenue, and you're backing out the merchant fees and things like chargebacks and refunds, and you're taking that net revenue, and all you're really doing is comparing that to all of your costs, right? So you're taking your net revenue, then you're totaling up your costs, like advertising, like cost of goods sold, whatever other subscriptions you paid for, you pay Shopify $29 a month, whatever else you've got in terms of expenses. And then you amortize that. Do you amortize those expenses out, like the monthly expenses, on a day-to-day basis before, because you're trying to get like a daily number, right? So you're taking, like, let's say for example, on Monday, you're taking the net revenues, you're subtracting the costs, the one-time costs like advertising and cost of goods sold from Monday, and then are you amortizing the rest of the costs into a daily number?
Yeah. So to be honest with you, I think it depends on the entrepreneur and their preference in general. Um, so first of all, I think that you should have a pulse on all those other items for sure, but a lot of those things are variable and are difficult to calculate what your actual daily cost is if you're looking at this on a daily basis, which I do recommend. Um, the way I like to put it is keep it simple enough so that you don't hate doing it every single day, but also complicated enough so that you can make informed decisions. So that if you're the type of person that's like, you know what, I need to have that, annualized number, that condensed estimated number for the rest of the stuff that's not included in the, ad spend, cost of goods sold, merchant fees, etc., then definitely include that in there. The other thing that I see people include in there, and this is a pain point for all drop shippers, and I'm sure we'll get into this soon, is cash reserves, the holdings that PayPal or Shopify payments or even other payment processors will hold from you, which makes this business difficult from a cash flow standpoint. But even something like that, if you're the type of person that needs that daily P&L to also account for your cash flows, that's something else you should consider throwing in there. So on a daily basis, like, yeah, I made $200 yesterday, but if the payment processor is holding 10% of my top line sales, that $200 in profits might actually be $40 in profits very quickly. So something else to consider.
Yeah. Okay. So, and then there would be other costs associated, like if you have a VA working for you, you're kind of just, this is a high level estimation, right? So if you say, I usually pay my VA $100 a week, you can advertise that, you can divide that by 7 and get a daily number, and take the other subscriptions and the monthly subscriptions, divide by 30 and try to get a daily number. That way you can have a reasonable estimate of, I know that in fixed expenses, how much I pay, and my variable expenses are dependent on how many sales I made and how much I advertised. But I think it's to your point, a good. I would definitely be the kind of person that would want to have an idea of both, so I could have as accurate of a high level view as possible. It's really not difficult to figure out. I spend $100 in subscription expenses, or fixed expenses a month, so that's about $3 a day, and add that into the total.
And what's important to understand is, remember, there's the two sides to it. There's the daily thing so you can move fast, and then there's the bookkeeping part of it, which is like the final. Think of it as like, one is like the draft essay, the other part of it's like the final draft of the essay, right? So the estimate portion of it is always going to be changing in terms of what you find valuable to track, things you need to track more closely, et cetera. So it's not like day one you're going to set something up and it's like set it and forget it forever. It's always going to be perfect. It's always going to be changing as you determine, like, oh wow, like I was tracking my estimate for a month, but then when I did my bookkeeping, I realized that, crap, I'm spending a lot of money on VAs. Maybe I should be tracking that more closely. So that's when you can make the decision where, like, I wasn't tracking VAs before, but now I'm for sure going to track that because it's something I need to consider as I'm making decisions in my business.
Right. Now you have data to look at. Now you can say, wow, I am spending a lot of money on VAs. Why don't I go in and audit, how many emails they should be answering per hour, how many emails they are answering per hour, how can I make them more efficient? Can I give them more canned responses to use so they can answer faster?
Right.
Yeah.
I definitely do not be the entrepreneur that is solely focused on sales. Obviously, I see it all the time, especially because the dropshipping space, at least in my experience, tends to be a younger crowd. So they don't have as much financial literacy as someone who maybe has been in business for 10 years, let's say, right? So what I see is a trend is a lot of entrepreneurs in the space will be so focused on their sales and not on these other things that they often get confused, where it's like, how did I do $100,000 in sales last month, but I only have like $5,000 in my bank account? Like, how does that happen? So these sorts of things that we're talking about now really kind of connect the dots between the two.
Yeah. It allows you to tell a story or understand the story of your online business, really. And I think a lot of people may take it that aspect of it lightly. You know, they aren't super focused on, you know, they're like, I'm making all these sales, it's amazing, but like you said, at the end of the month, you know, I've only got $5K in my bank account. I thought I was going to have like 20 or 25, right? So this stuff is crucial to help you get to sort of that next level. So that's the bird's eye view, high level, 30,000 feet. What is happening with my business? Like, do I need to make any drastic changes? And then there's the bookkeeping side of things, right? So this is like every single transaction and every single dollar that's coming into my bank account.
Yep. So first step towards that is, number one, as a business person in general, you want to start to bifurcate your personal bank account, personal credit cards from your business bank account, business credit cards. Number one, because it's required. We can talk about legally, tax-wise, with IRS, etc. But just overall keeping organized, it's very important. So once you have that business bank account, business credit card set up, what you do is you set up a QuickBooks account. You link up that business bank account, business credit card, and you can have multiple of each, obviously, but you connect it to a system like QuickBooks or Xero. There's a whole slew of bookkeeping softwares out there. I personally recommend everyone use QuickBooks because it's user-friendly. There's a ton of content out there on YouTube and stuff for you to learn QuickBooks. But once you have that set up, you connect that business bank account, business credit card, what happens is there's a live feed of transactions that come through to the software. And like I said before, you know, you'll know as soon as you see like, oh, Facebook charged $900. It's like, oh yeah, that's ad spend. So you categorize it as ad spend. You know, you see a charge coming from Zendrop. You know, it's like, oh yeah, that's my, you know, that's cost of goods sold. So what happens is you categorize all of your transactions over the course of a month. And as long as all of your business transactions hit that business bank account, business credit card, etc., you're not going to miss anything. So oftentimes what happens is you're going to notice that that profit number is going to tell a tremendous story, because you're going to see an itemized list of everything that that makes up that number. And I can pull up an example here too. I have a redacted version of a dropshipper P&L that I can share. But basically, a lot of times, the first time I send that P&L statement to like a dropshipping client, let's say, they'll be shocked as to like, wow, you know, I had 800K in sales this year, but my profits are only like 60K. Like, how is that possible? And they see like, wow, I have $20,000 in contractor expenses. Who am I paying? Like, oh, I thought I let that guy go, but he's still charging me on Upwork. And these things come up all the time. And by having thorough bookkeeping and keeping a pulse on those numbers, that's really the only way that you're going to catch things like that, you know? So yeah.
Yeah, that's a good point. So that's going to be a extremely detailed view of exactly what's actually hitting your bank account, and that may flag, and likely, you know, usually does flag expenses that, you know, you may have forgotten about or never canceled, or it might be alarming to look at the first time, but it's better to catch it sooner than later.
For sure.
So okay, that's a great breakdown of sort of the basic financials that someone should have set up if they're running a business. You can get, you know, the business bank account and the business credit cards don't cost anything. All you need to do is open up an LLC on LegalZoom. I don't know, it's $150 or something like that. Fairly inexpensive to open up, and that's what you'd recommend, right? An LLC for a dropshipper.
Yeah, for sure. And a lot of people in this space are beginner types or just getting into entrepreneurship. And I get the whole, you know, $300 to $500 to set up an LLC is like, that blows your budget. You know, you weren't planning to spend that much in business. So it's okay in the beginning to, you know, operate without a legal entity. And my recommendation there would be, still, when I say business bank account, business credit card, doesn't necessarily have to be, you know, Brad Loeffler LLC. You know, if it's just a matter of getting organized, go to a different bank, open up a bank account, and get a credit card that you're just going to use for business to get started. So at the very least, you're organized. But to answer your question, yes, LLC is absolutely. So I'm going to break this into two categories. If you're an American, okay, drop shipper, LLC is the way to go, because what you can do later on is, as you make more money, you can start tax planning. And if you select another business entity type, it may not be as easy. LLCs have flexible tax treatment. So I'll leave it there because it's a rabbit hole in itself. We can jump in there if you want. But if you're an American dropshipping entrepreneur, use an LLC. Whether you have partners, whether you have it by yourself, doesn't matter. LLC is the way to go. If you're a foreign entrepreneur, it kind of depends. I do recommend going with the same LLC, business entity type, but the tax treatment varies depending on your goals. If you're a foreign entrepreneur that only has a US LLC for purposes of, you want to operate in US dollar, you want to have a store that is selling US dollar, then the US LLC is all you need, and you don't have to do any specialized tax selections. However, if you're a foreign entrepreneur that has a high tax rate in your country, there are ways that you can force US taxation so you don't have to pay taxes in your foreign country. But again, that's super, super technical stuff. So to make it simple, LLCs make sense for pretty much everyone. It's everyone if you're an American. If you're an overseas business owner, I would recommend consulting with an American tax professional.
Great. We'll leave it at that for now. I don't want to get too deep into that. I know that's a whole nother tax planning rabbit hole we can get into.
Everyone might fall asleep if we.
What do you think what would you say like the dollar amount is to where it makes sense to consult a tax professional about some sort of tax planning strategy? What net profit number do you have to be at?
Yep. So I would actually base it on sales. So what I recommend is base it on the IRS's threshold for when you go on their radar. So for any payment processor, think of like Stripe, PayPal, Shopify payments, if you're working with Bank Card or any of these other companies out there, as soon as you cross $20,000 in credit card processing with any one merchant account, then they have a legal obligation to notify the IRS that you're making money. So if any of you have received that form 1099-K in the mail and you're like, what the heck is this? This looks like about my sales from last year, but why am I getting this in the mail? Just so you know, the IRS gets a copy of that as well. And it's completely automated. They electronically get a version of that file. So the IRS knows that you're getting sales. So if you get a letter in the mail that says like, oh, I had $100,000 in sales according to this form 1099-K, the IRS is expecting for you to put that number on a tax return somewhere. So to answer your question, as soon as you hit 20K in sales, and for any payment processor, I recommend at the very least having an accountant do your tax return. And the reasoning is very simple, because it becomes slightly more complicated where doing your tax return on TurboTax becomes certainly more risky. And a licensed professional would make sure that nothing falls through the cracks. And at the very least, you're reporting what you're supposed to.
And that's just because now you're not just accepting money from an employer, you're now accepting money from all these different people in all these different places, and you might have potential liabilities, right?
Yep. The IRS officially considers you self-employed, and they're looking for that income. So that's for sure. And for those of you that are in a situation where you're like, wow, I got one of those forms, I didn't file a tax return. Basically, people think automatically like, oh my God, I'm going to go to jail. That's not necessarily the case, but what you may get is a very ugly letter from the IRS in the mail that says, hey, we saw you have $100,000 in sales. We think you owe this amount of money in tax. So that's usually what happens in that situation. If that does come up, do not pay it. Just file a tax return. Call the IRS, let them know the situation. You file a tax return, and it pretty much all goes away.
So on the topic of sales tax, I think one of the most common questions that new entrepreneurs and dropshippers have about sales tax is, do I collect it for my customers, and what do I pay to the IRS?
Yeah. So it's extremely confusing. So for those of you that are watching this, if you're still confused after this, and I apologize, the rules are extremely tricky. So what I've done for me, since I have a small brain, is I've made some simple rules that make it easy for me to remember and explain to other people that aren't accountants. So basically with sales tax, there's two things you have to pay attention to, okay? Where you have a physical presence and where you have a lot of sales. Think of it as like a two-step program. First is like, where does my business have a physical presence? Number two is, where does my company have a lot of sales? So
sorry to cut you off, but I know this question is going to come up. If your business is online, and where technically, where does your business live then?
Yep. So I was just going to get into that. In terms of physical presence, it's three things. Number one, it's where are you personally located? As the person operating the business, where are you located? You're sitting behind a computer screen somewhere, right? So sales taxes is a state tax. It's not like an IRS tax. So this is based on state to state. You have to make this determination. So for me, I'm in sunny Florida. If I had a drop shipping business, I am personally sitting in Florida, operating my drop shipping business from Florida. So the way that sales tax works is my business has a physical presence in Florida. So that's number one, physical presence. Number two is where you have employees, which is not very common. I'm not talking about like VAs or contractors, the accountant you paid. I'm talking about like who you giving a W-2 to, which is pretty rare, for like this solopreneur type of business. So that's very uncommon. But number three might be common. If you start graduating to that point where you're warehousing inventory, that does get considered as a physical presence. So I see this all the time where an entrepreneur is like, I found that evergreen product. I've used drop shipping to test. Now I've got my product. Now I'm going to buy in bulk, warehouse in the US, and fulfill from the US to help with the customer experience. Wherever your inventory is located, you have a physical presence. So if you live in sunny Florida, like I do, but my inventory is in Idaho, then I technically, from a business standpoint, have a physical presence in Idaho and Florida. So that's how the physical presence part of this works. And right now we're talking about the states that you have to worry about sales taxes for, okay? And then I'll get into how sales taxes work after, like what it means, etc.
So for physical presence, sorry to interrupt, I just want to clear this up. You wouldn't be considering virtual assistants or contractors of any capacity, only employees that you give a W-2 to.
Right.
And then for the physical presence, let's say in your example, you live in Florida, you have inventory in Idaho, you're obligated to pay sales tax in both of those states.
Yes.
Got it.
Yeah. Now, that's physical presence. If you're a pure drop shipper, it's where you located. If you have partners, you might be one partner's in Montana and one partner's in Florida. You have physical presence in Montana and Florida. So just like something to consider. And listen, sales tax is not the end of the world. So I don't want people to think, oh my God, I got to pay taxes in all these places. We'll get into sales taxes and like squashing a lot of the myths, etc. But just the first step is understanding where you have risk. Okay. Now, so that is physical presence. That's step one. Step two is a new set of rules, which is confusing everyone, and accountants included. And it's this whole economic nexus rule, or rules, I should say, which basically says the old rules said you don't have to have a physical or to have sales tax risk, you have to have physical presence in that state. But the new rules say that even if you don't have a physical presence, if you have a lot of sales, then you also have risk of sales taxes there in that state as well. So for example, in my example, I have inventory in Idaho and I live in Florida. But in New York, I have a lot of sales. New York will say, I don't care that you don't have a physical presence in our state. You ship a lot of products into our state, and therefore you should be collecting and remitting sales taxes here in New York. So the best way to understand that, because every state has their own rules, which makes this highly complex. The best set of rules, if you're trying to gut check this to see like, oh my God, do I have risk of sales tax nexus in that state? Is you say, okay, 200 transactions or $100,000 in sales in that state over the last 12 months. In other words, let's go back to the Idaho, Florida example. Okay. New York, let's say I have $30,000 in sales in the last 12 months. Obviously, that's not $100,000 in sales, so I don't trip up that rule. But if I have over 200 sales transactions, technically speaking, New York can come after me and say, hey, you have Nexus in our state. You should be collecting and remitting sales taxes. Now, to be completely transparent, is it feasible for you to really follow the rules to a T for every single state? The answer is probably no. The reality is, in a space that we're in, where most of the people are solopreneurs or small companies in terms of headcount, even though you're scaling to large numbers, you got to think about it from a risk-based standpoint. So for example, let's use average order value of $30. Okay. Let's say you have 500 transactions at $30, right? So 500 times 30 is what? That's 15,000, right? Yep. So you have $15,000 in sales in New York, okay? Technically speaking, New York might say you have sales tax nexus in our state, okay? Now, according to their rules. Now, what's really the risk here? $15,000 times the sales tax rate, let's just call it 10%, so the math is easy. $1,500 worth of sales taxes that you should have collected from customers and are paying into New York, okay? So the reality is a state is not going to audit you for $1,500. It would be very difficult for them to, number one, figure out that you are shipping to their state because you have no physical presence there. Number two, they would have to audit you and actually find the evidence to prove that you did have those products shipped into the state. But also, is it worth that state's time to go after a business owner that only has $15,000 in that state? The states kind of operate like a business too. If they shake you down, they want to shake you down for a lot of money, so it's worth their time to audit you and get the money. So my recommendation to kind of simplify what you should be doing for sales taxes is focus on where you have a physical presence, which is easy. That's where you have the most risk. And then if you hit $100,000 over a 12-month period in total sales in a particular state, then you start to assess like, wow, maybe I should be collecting and remitting sales tax in that state. So
is there a way to, let's say you've got a niche product and it's a Chicago Bears product, or it's something that Chicago Bears fans might like, and you're really selling a lot of products to Chicago in Illinois. Is there a way, do you know if there's a way in the Shopify settings, I actually don't know this, if you're able to apply sales tax on just orders going to one state?
Yes. So when you go into the taxes section within Shopify, it's literally like you have to enable sales tax collection for certain jurisdictions. So in your situation, if you're like, wow, I send a ton of stuff in Chicago, keep in mind sales taxes for the most part is state level, so that would mean Illinois. So what you would do in theory is you would turn on sales taxes in Illinois. Now, let me take a step back because people might be getting confused in terms of what sales taxes are. And this is, now that you have the understanding of where you have risk, remember the physical presence and the economic nexus, just to keep it super, super simple. Where are you physically located? Where do you have inventory? Where are you located? Where are your employees? And then you throw on, just to account for economic nexus, you throw on where do you have $100,000 in sales in the last 12 months in terms of states. Now you should have like a list of states that's like, okay, these are states I think I have risk in. Now, to understand what sales taxes are is pretty simple if you think about it. If you think of like when you went shopping at a clothing store, right? You see a t-shirt on the rack you like, it says $20. When you go to check out, you can't just slip the cashier a $20 bill. Why? Because that store charges sales taxes. So you're paying $20 plus whatever the sales tax is. Now, what that store does is the $20 is their money. That's their sticker price for the product. They take your $20 plus sales taxes, the $20 is their money. The rest of the money, still they keep, it goes into their bank account, but they have a legal obligation to remit that payment into the state tax authority. For example, let's say it's a $20 shirt and sales taxes on a $20 shirt is $2. The store, you as a customer pay $22. $20 of which is the store owner's money. That's their, their revenues based on selling the product, plus $2 is actually held to pay into the state. In your example, would be Illinois. So in terms of sales tax risk, we're determining what states that you have Nexus in, because we need to figure out what states you have to turn on that switch to collect sales taxes from your customers. And it's very, very simple at Shopify. What happens is, if you think about the checkout process, customer picks a product, it goes into their cart, they go into their cart, they proceed to checkout. Once they enter in their shipping address, automatically in the back end of Shopify, if they're putting in a state that you have sales taxes turned on, automatically that customer is going to be charged sales tax based on whatever their shipping address is. So let's say, let's use the example I just did. If I am selling a product to a customer in Florida, I determined I had Nexus in Florida. On my Shopify store, I turn on sales taxes. So as soon as that customer says, I'm shipping to Boca Raton, Florida, boom, that sales tax number is going to be added to their amount that they have to pay for. So if they check out, let's say in Tennessee, where I determined I don't have sales tax, then upon checkout, when they enter in Tennessee as their shipping address, no sales tax gets calculated and charged. So what happens is, as soon as you collect that, you charge them the sales tax, you collect it, then you have an obligation for that sales tax that you've collected to pay it into whatever state it's applicable to.
Gotcha. So yeah. that makes perfect sense. Whatever physical locations you have Nexus in, and whatever locations you happen to be selling more than 200 units, but really closer to that 100K in total sales mark, you should flip on the tax setting in Shopify. And yeah. I would not flip it on for anything you didn't necessarily need to, because if you're new to this, you may not realize how drastic slight variances and change could affect your conversion rate. 5 or 10% could be the difference. 5 or 10% in pricing could be the difference between 1 or 2 percentage points. And that could be the make or break, is this product profitable and can I scale it, or is it actually losing money?
For sure. And that's a really, really great point is, and some of the more seasoned e-commerce entrepreneurs out there are gonna feel this too, is that checkout process, your goal should be making it as frictionless as possible. And it's a fact that, if that customer goes through, likes the product, they add it to their cart, then they're ready to check out. As soon as they put in the shipping address, it's like, boom, they have $3 extra that they have to pay you. That adds friction. It's a fact. So if they were 90% sold, now they're down to like 80% sold, where it's like, I was willing to pay $20 for it, but now it's 22. Maybe I should check Amazon. Maybe I should shop around. Maybe I should think about it, So you want to be careful with two things. Number one, there's certain states that, if you're on the borderline of having Nexus or not, and you want to take that risk-based approach. It might make more sense because your conversions are going to be higher. But also, don't sleep on the fact that compliance is a pain in the neck. Tax authorities, whether it's the IRS, state tax authorities, they all have different ways of paying them, of submitting tax returns to them. And it's complex to the point where, it's very likely that if you have Nexus in more than one state, you're going to want to pay a professional because it's just a headache to deal with. And if you decide you want to be, what I like to call compliant, with all of the states for sales taxes, please hire us because you'll be our favorite client and you'll pay us a lot of money to focus on all of the, being compliant in all the states. So it's okay to take a more risk-based approach in terms of, where you're going to file for sales taxes. But as long as you keep to the guidelines that I laid out, you should be pretty safe. It's not 100% foolproof, but as long as you focus on physical presence and over that 100K threshold, it's you should be fine.
So I want to talk about cash flow. The next topic, and probably the last one, we'll wrap it up after that. So it is a touchy subject in the dropshipping world. Definitely, the cash flow aspect of the business can be the most difficult for some entrepreneurs, especially getting their money held in Stripe and PayPal. Do you have any recommendations about how to avoid that scenario, if at all possible, and B, if it does happen, any potential alternate solutions to getting your money back faster or not having it tied up again?
Yeah, so unfortunately, and I work with some of the most seasoned, e-commerce business owners in the game, so I've seen people that have scaled, up to $1 million in a week in sales, people that make big time dollars in this space. The reality is that you're going to be faced with payment processors holding your money. That's just a fact. And especially if you're drop shipping from China, it's going to be hard on your customer support. And the longer your shipping times are, the more you have to deal with, customer complaints, and your chargebacks or refunds will be higher, and that's going to reflect on your cash reserves. So my overall recommendation would be to make sure that you're accounting for it. Just because your money is tied up does not mean you're not going to get it. You just have to have a plan for, okay, cash is tight, but really on paper, when am I going to get that money? And how can I continue to operate? Knowing that you're going to get that cash, but it might be, 30 days out, or, for a company like PayPal, for example, they're known to, like, in the beginning, if you're a drop shipper, like really crunch down on you and really force you to prove yourself. But as long as that PayPal account still has consistent sales, you're not getting crushed with chargebacks, etc. As that PayPal account becomes more and more seasoned, the less strict they are with their cash reserves. So my overall recommendation would be twofold. Number one is be in constant contact with, whether it's PayPal, Stripe, Shopify payments, a third party, etc. Just be in constant contact with them. Because a lot of times, you're one rep away from, like, what, you're at a 15% reserve, but you've been pretty good with your chargebacks. Let's move it down to 10%, which every little bit helps. But number two is be informed. Have that financial data that gives you the mindset and the ammunition to really know, like, what the next move is going to be, So I think as long as you have those two things and acknowledge the fact that you're going to run into these situations with your cash being tied up, you should be fine.
What can you do if your cash is tied up and you've sort of exhausted all your options about potentially getting it released sooner? Is there anything else that you could do to continue to run traffic to your store? Yeah,
so I would be very careful if you're in that situation. You definitely want to have some sort of cash flow, because they say cash is king for a reason. You want to make sure you have some cash to operate your business. But in this space, credit cards can be an extremely powerful thing. What's cool about credit cards is depending on, this is a rabbit hole in itself, but depending on the type of credit card points you're getting or cashback rewards or whatever, that those typically are not taxable. So you can rack up a ton of credit card points if you have a credit card like tied to your Facebook account. And if you tie it to, like, for example, if you're using your credit card for Zendrop, your credit card points can really rack up quickly. But to answer your question, credit cards can be an extremely powerful thing, because if you're dealing on a 3 to 7 day lag period between when your sale happens and when you get your cash from your payment processor, it'll still enable you to scale up, to keep spending the money on the ads while you're waiting on that cash to come in. So credit cards is an extremely useful tool in this space where you deal with cash getting tied up with payment processors.
Are there any particular credit cards you'd recommend for someone advertising a lot?
I don't really keep track of that stuff, but I know there must be a reason for this. I see a lot of dropshippers using the Amex Gold card. I don't know why. Maybe the credit card points are great. I don't really keep a pulse on that stuff, but it's just a trend that I'm seeing now.
Yeah, I do know Amex has really good points structures and systems. I was just curious if you had any good recommendations. But yeah, I think I would say that Amex and Chase, I would say, are probably the two best options. Amex Gold and Platinum are also really good options for someone spending a lot on advertising.
Yeah, and if you're keep in mind, a lot of this audience is younger too. So what a lot of people might be running into is like, oh, I'm 18 and I can't get a credit card. The thing is with credit is it's kind of like you got to season it a little bit. You have to, start slow, and you have to start getting the transactions and paying your card down and building that credit history. So there's absolutely companies out there that will give you a credit card even though you're 18 years old. And even though that credit limit might be $2,000, it's okay to, put $500 on it, pay it down, and then, do that for a month or 2 months, call up that credit card company and say, hey, I have good payment history, right? Can you increase my limit? And you kind of build it up from there. So don't sleep on the fact, like a big time, I don't want to say excuse, but like a point of friction, I'll say, for entrepreneurs is like, hey, I would love to scale up and keep fulfilling orders and keep running my ads, but I can't because I have no credit. There's plenty of credit card companies out there that will take you on. You just have to find them.
It's a good point. The leveraging credit, if you do it carefully and smart, is definitely a really good way to be able to combat that cash flow issue. Like Chris said, even if they give you $500 credit limit, right? You keep racking it up and paying it off, and you can call them and they should be able to increase it pretty quickly. You're basically, when we open a line of credit, you're building a relationship with the bank, and you're saying, hey, like, I'd love to borrow some money from you. And they go, okay, well, we don't know, you've never done that before and paid anyone back. So we're going to give you a little bit. We'll give you a few $100 and we'll see how it goes. But if you continuously rack up a balance, pay it off, and if they see that you're constantly using almost all the limit they gave you and paying it off consistently, it's usually a pretty simple phone call that takes less than a few minutes, and they can increase the credit limit on the card.
Yeah.
Any last words for anyone out there that may either just be starting drop shipping or even maybe a little bit more seasoned?
Yeah, so for the beginners out there, definitely keep at it. I'm in an interesting situation where I only focus on entrepreneurs that are in this e-commerce space. And like I said, most of my clients are drop shippers. And I've seen all people from all different walks of life, all over the world, all different ages, from teenagers all the way up to mid 50s, people that just, have found success in drop shipping and love it. And it's a great business model. And, no matter who you are, this is a great opportunity for you to learn a business and grow. There's definitely money out there to be made. And then for the more seasoned people, don't sleep on the financial part of your business. I've seen people fall into holes that, kind of snowball from 6 months out, and they become a bigger and bigger and bigger and bigger problem. And they simply arise because you're not keeping a pulse on your business. So for the more seasoned people out there, keep a pulse on your financial data because it's very important. Yeah.
Chris, I really appreciate you hopping on and providing some value. Where can people find you?
Instagram. My Instagram is easy to remember. Just DM me at ecom accountant. It's at ecom accountant. And I'm cute. I spend a lot of my time working with Zendrop, so feel free to reach out with questions related to Zendrop or questions related to me, or I have some people in my DMs answering tax questions. So if those come up, feel free to reach out there. But yeah, that's the best way to reach me.
Cool. Thanks, man. Appreciate it.
Thanks.
See ya. All right, episode's over. Really hope you guys enjoyed that episode. Please like, comment, subscribe, leave us a review on iTunes. Would mean the world to us. And give us any feedback that you have, episodes you'd might want to listen to, guests you'd want us to have on. We'll do our best to accommodate. Your feedback means everything to us.